A weak 30-year bond auction sends U.S. government bonds tumbling lower amid a sell-off in the dollar and U.S. stocks. Is the de-dollarization trade back? So a number of big market moves today. We had stocks sharply lower. We also had the dollar lower and bonds lower. So to start with, here we had a 30-year bond auction. We've had a couple bond auctions recently. 10-year auction yesterday, not too strong. Here today, a 30-year bond auction. We can see high yield 4.69%. Yields have ticked up since the auction closed in a tail of 1 basis point. That's the second in a row, and that is the largest going back to August. Now, remember, what a tail indicates is the U.S. Treasury had to offer a discount on the bond's price in order to entice enough buyers to come in and absorb the entire supply, in this case, $29 billion. Now, with a bond, remember, a discount on the price means a higher interest rate. So, if you are a taxpayer, you do not like to see a tail. And as we can see with the 30-year, it has been tailing quite often. Now, here, by the way, is the side-by-side with the 10-year, and then finally with the 3-year. So you can see the demand for the long end has been waning, arguably for years now, compared to something like the 2-year or the 3-year, which shows more healthy demand, even the 10-year struggling relative to the short end of the yield curve like the 2 or the 3. Now, the bid to cover, total number of bids divided by the total amount of supply, 2.29, relatively low here. Lowest since August, and the second lowest going all the way back to 2023. So bid to cover, again, higher is better, lower is worse. We can see that line in red. Again, total bids divided by the total supply. Yellow line shows the yield that the auction closed at or cleared at, and then the colored bar shows you the relative share of the total auction that each buying group took down. So indirect, that is a proxy for foreign demand. Direct bidders in green, that is firms bidding directly for their own book. And then primary dealers, those are a buyer of last resort. They have a special arrangement with the Treasury and the Fed. You don't want to see a high primary dealer takedown. That has been increasing over the past 3 or 4 auctions, as we can see by the blue bar. Primary dealers took down 14.5%, most since August. And again, it's been going up for the past 3, 4, 5 auctions. Direct bidders took down 14.5%. That is the lowest going back to October of last year. Indirect bidders took down the highest share going back to August of 2024. A lot of people, especially with the recent video we did on the Cayman Islands, those highly levered hedge funds in the Cayman Islands in the basis trade that are buying cash treasuries and then shorting the futures contract. I found conflicting evidence whether they're considered indirect or direct. But then I went to AI and I said, do an exhaustive search and tell me for sure, is a hedge fund that might be engaged in a 100-to-1 levered hedge fund basis trade in the Cayman Islands, are they indirect or direct? And AI said that they would be recorded as indirect. So again, strong indirect demand generally seen as a good sign. You want foreign strong creditor nations like China running a very large current account surplus. Generally, you would want strong indirect demand at your bond auction. But now that we know that some of those highly levered hedge funds might be recorded as indirect, maybe it doesn't mean so much anymore. By the way, Andy Constant gave this auction a C-. Yesterday's 10-year auction also got a C-. Now, here's TLT. This is the long bond ETF. This is going to track the actual bond's price, and of course, the yield would be inverse to this. Here, we can see that bonds were trading. The long bond was trading basically flat on the day, and then the auction results were announced here, and we can see that bonds, specifically the long bond, sold off into close. Now, here's a look at the yield curve. We can see we have been in a bit of a steepener the past week or two. Remember, what that means is the gap between the 30-year yield and the 2-year yield is growing wider. Right now, you get 1.12% more interest if you buy the 30-year yield the 30-year bond than if you buy the 2-year bond. But remember that a steepener, the gap growing wider, that steepness, can occur in 2 different ways. It can occur in a bear steepener or a bull steepener. And we have been vacillating between the two over the past couple weeks. So here we can see a lot of kind of whipsaw action. Of course, the Federal Reserve cut interest rates back here in mid October, and yields have moved sharply higher ever since. Of course, buy the rumor, sell the news a bit, and a bit of a hawkish tilt from Jerome Powell. We also had some hawkish Fed speak earlier today, but we also had this kind of sell America sort of trade maybe starting to reappear. So I noticed it this morning as well. I wake up very early here on the West Coast, and I noticed that bonds were down, or futures for stocks were down, bonds were down, yields were up, and the dollar was down. Now, this is something that I started to notice back in February of this year, way before the Sell America de-dollarization narrative got started. I would realize every morning I'd wake up and I'd see the same thing. Stock futures would be down, bond yields would be up, bonds would be down, and the dollar would be down. Now, that is textbook capital rotation when you see that, especially when you see it during a foreign session, right? So when I'm waking up, I'm seeing kind of the tail end of European session. And that is what I was starting to notice back in February, March. Then, of course, it really accelerated into April. Well, again, I've been starting to notice hints of that the past week or so. I'll wake up, see bonds down, stocks down, and the dollar down. We saw that again today. The DXY dollar index at one point was down about 0.6%, which is a pretty significant move in the dollar in the global reserve currency index. Remember, that is the dollar relative to other currencies. We'll get to that in a second. Bitcoin broke below 100K. We had stocks sharply lower here. We can see the S&P 500, for example, closed the gap that had been left a couple days ago. NASDAQ down over 2%. So pretty sharp move lower in stocks. And of course, a steepener. And not only that, but a bear steepener is starting to return. Now, what is that? What could be causing a sell America sort of narrative? Well, again, I noticed it in the early morning here, but later on in the day, you did have some administration officials, I believe it was Kevin Hassett, announced that some of that economic data was basically just gone and corrupted forever. It was really kind of strange comments from Kevin Hassett and some of the administration regarding some of the economic data that we are going to hopefully be getting over the next couple weeks as the government reopens. So, in an emerging market that is basically cooking the books, I'm not saying the US is doing that, but hypothetically, if you were in an emerging market that's highly indebted and there were signals that administration officials were going to start cooking the books, you would see exactly that. You would see stocks down in that native currency, just like we saw today. You would see bonds down, yields up, and of course, you would see their currency down. Imagine you are a German and you are in US Treasury, say the 30-year. Well, if you don't want to be in dollar denominated assets anymore, you sell your bond. Well, when you sell your bond, that puts upward pressure on the yield. And then, of course, you're left with dollars because the bond, the US Treasury, is a dollar denominated asset. Well, you don't want to be in dollars, of course, because you think that the US is cooking the books. You can't rely on the economic data. It's basically going full blown emerging market. So, what do? You sell the dollar. You sold your bond. Now you have dollars. Then you sell the dollar to buy something else. So, the question, if Bitcoin was below 100K, pretty weak on the day, down about almost 3%, gold was trying to mount a rally, but even gold couldn't gain on the day. Gold closed down 0.5%. It asked the question of what was up. So I did want to point to move index. We mentioned the whipsaw action with bonds over the past couple weeks. Move index inverted. So as bond volatility is declining or decreasing, that is generally good for stocks, as we can see in the blue line. Well, bond market volatility has been heading higher. So a bit of a hiccup in stocks might be expected if you believe that this correlation or inverse correlation would hold. Now, so it gets to the question of, okay, if everyone was selling their US stocks and their US treasuries and then selling the dollar, what were they buying? So again, very similar to January, February, March, when this was really starting, you saw the Swiss franc up, the euro up, and the yen up. So that is what we saw, at least today. Of course, the yen has been weakening with the new populist prime minister, very, very dovish prime minister there. And as we can see, of course, if dollar Swiss franc is moving down and to the right, remember that means the Swiss franc is strengthening against the dollar, or put another way, the dollar is weakening against the Swiss franc. So hopefully a more intuitive way of looking at it. These are the three that were really making the most major move today. So of course, stocks here in the the US ES closed down about 1.7%. The S&P 500, Nasdaq closed down about 2%. IWM, the small and medium cap companies, that closed down 2.8%. Really got hammered today. The equal weight S&P only closed down 1.1%. So there's some of that kind of maybe rotation out of the Mag 7 as well, with the equal weight performing significantly better than the market cap weighted S&P 500 like the SPY. And of course, you look at these currencies, there was clearly some strength going into the Swiss franc, the euro, and the yen. To some degree, again, over the past 10, 11 months, this has been the safety trade. Now, normally gold is in here too, but as we went over in the prior slide, we could see that gold was not able to gain on the day. It closed down about 0.5%. So, anyways, hopefully a lot going on. Hopefully that was helpful, and we'll stay tuned for the repo market. We'll take a look at that tomorrow morning, see if there's any developments there, and of course, anything in the markets. And I will catch you on the next one.